Jeff, it is great to have you. We lead in like that because about a month ago you said we're in inning 2 or 3 of the valuation reset in VC-backed tech companies. What inning today? And then when you say this uptick in deal activity, what specifically are we talking about?
Yeah, it's a great question. You know, I just think folks were in retrenchment mode in Q2. And in Q1, we had so many shocks to the system. We had the market turning downward, multiples turning downward. We had rates going up. And of course, we had the war with Russia attacking Ukraine. And so Q2 was really just a moment for investors to take stock and try to figure out where to hide. We're seeing more deal activity now. We're seeing engagement with our private companies. We've also seen the private companies reset their valuation expectations a little bit. Some notable ones that you guys have covered with things like Klarna and Instacart. And so that's healthy for the market. It's a good dynamic. It means that folks are warming up to a new reality. And I think we'll see more activity in Q3 heading into Q4. We also, as you guys have highlighted, we still have strong fundamentals on the earnings front. Maybe there's a shoe to drop, but we're not seeing that in the portfolio. We're still seeing healthy performance among our portfolio companies, which was not something we saw in prior downturns like 08-09, where it was pretty systemic downturn across the portfolio.
So do you expect that to get reflected in public results? And if so, what is the lead time on something like that?
Well, the public market, as you know, is such a reflection of sentiment, right? Largely driven by hedge funds and retail investors who move the market. I think it's been hard for those folks to pile in as well. And so maybe we start to see some of those folks. Obviously, we have record amounts of cash sitting on the sidelines, not only with hedge funds and retail investors, family offices, as well as corporations. I mean, obviously, companies like Apple have done an amazing job with buybacks, but your average public company is sitting on a huge war chest, not to mention the hundreds of companies that went public the last few years, which have record amounts of capital. So it's hard not to be optimistic heading into next year. You know, we look a lot, as you guys know, at the small business sector. One of the companies I'm involved in called Homebase did a survey of SMBs recently. 92% of SMBs said they plan to hire this year. That's a pretty healthy number given everything that's gone on over the last 6 months and should bode well for public names like RingCentral, Square, Toast, some of those companies that sell technology into SMBs.
And Jeff, as you look at those public companies and the cash they have and the fact that their stocks are way down, though, how much of the M&A that you're predicting is going to be those public companies making acquisitions versus deals among the private companies as they reckon with down rounds?
Well, we're also starting to see private equity creep in, right? We saw the Zendesk deal with Hellman and Friedman. We saw Thoma Bravo acquire Anaplan. I think we'll see more of that. Smart investors taking advantage of a down market, and multiples today for software are below. You know, the last 7-year average for SaaS is about 7x next 12 months revenue. We're actually below that right now. So we may see more of that private equity activity. And then, as you mentioned, public companies trying to buy smaller private companies. But we have to, the valuation mismatch has to work itself through. It's sort of a pig in a python of deal activity that we've been working through over the last 6 months.